Welcome. In this video, we'll explore the appointment and qualifications of directors under the Companies Act 2013. Directors are the individuals responsible for managing a company's affairs. Since a company is an artificial legal entity, it needs human agents to act on its behalf. That's where directors come in. They are elected or appointed to ensure the company operates smoothly and in compliance with the law. Throughout this video, we'll cover who can be a director, how they. Directors act as both agents and trustees for the company. As agents, they enter into contract and make decisions on behalf of the company, binding it legally. As trustees, they are responsible for safeguarding the company's assets, funds, and confidential information. This dual role means directors must always act in the company's best interest, not for personal gain. If directors breach their fiduciary duty and the company suffers losses, they may be held liable. The law recognizes that. Collective body of directors is known as the board of directors, or simply the board. The board makes decisions collectively, not individually. For any decision to be valid, a quorum, meaning a minimum number of directors, must be present at board meeting. Sometimes, decisions can be made without a formal meeting, but they must still reflect the collective will of the board. This structure ensures that no single director can dominate the company's affairs and that decisions are made in the best interest. Every company must have a board of directors with a specific number of directors. For a public company, the minimum is 3 directors. For a private company, it's 2, and for a one-person company, just 1 director is required. The maximum number of directors is generally 15, but a company can appoint more by passing a special resolution. There are exemptions for government company and certain section art company, provided they meet filing requirements. This framework ensures companies are required to have at least 1 woman director on their board. This applies to every listed company and public company with either a paid-up share capital of 100 crore rupees or more or a turnover of 300 crore rupees or more. If a company falls under this category, it must appoint a woman director within 6 months of incorporation. If a vacancy arises, it must be filled by the next board meeting or within 3 months, whichever is later. This rule. Every company must have at least 1 director who has stayed in India for a total of not less than 182 days during the financial year. For newly incorporated companies, this requirement is calculated proportionately at the end of the financial year. The resident director rule ensures that there is always someone on the board who is familiar with local laws and available for decision-making in India. This helps companies stay compliant and responsive to regulatory requirements. Independent directors play a crucial role in corporate governance. Specified public companies must appoint independent directors to their board. These directors should have an independent mindset and not be influenced by other board members. Their main responsibility is to ensure that decisions are made in the best interest of the company and its stakeholders. Independent directors help prevent illegal or unethical decisions and provide an objective perspective on company affairs. Their appointment. Interested director is one who has a personal interest in a company transaction. When a director becomes interested in any deal or contract, they must disclose their interest at the appropriate time and forum. This disclosure is essential to maintain transparency and avoid conflicts of interest. The rules regarding interested directors are designed to protect the company from decisions that might benefit individual directors at the expense of the company or its shareholders. Board may include both executive and non-executive directors. Executive directors are involved in day-to-day management and operation, such as managing directors or whole-time directors. Non-executive directors, on the other hand, participate in board meetings and help shape company policy but are not involved in daily operation. Professional and nominee directors are examples of non-executive directors. Independent directors are a special category of non-executive. First directors of a company are usually named in the Articles of Association. If not, the individual subscribers to the memorandum are deemed to be the first directors until the company formally appoints directors. In a one-person company, the sole member is considered the first director. The tenure of first directors typically lasts until the first annual general meeting, after which regular appointments are made as per the company's rule. After the first director, all subsequent directors are generally appointed by the company in a general meeting. Shareholders gather to vote and decide on director appointment, ensuring that the company's owners have a say in who manages their business. However, there are exceptions where the board can appoint additional or alternate directors if empowered by the company's articles. This balance of power helps maintain both shareholder control and operational flexibility. Director Identification Number, or DIN, is a unique number allotted by the central government to any individual intending to become a director. No person can be appointed as a director without a DIN. The DIN system ensures that every director is uniquely identified, making it easier to track their appointments across different companies. The process for obtaining a DIN involves submitting an application with supporting documents and is mandatory before. Apply for DIN, an individual must submit an electronic application in the prescribed form, along with identity and address proof, a photograph, and a board resolution if applicable. The application is digitally signed and verified by a company officer or professional. Once submitted, the central government processes the application and communicates approval or rejection within 1 month. If the application is incomplete, the applicant is given 15 days to correct it. The DIN Allotted, a DIN must be used by the director in all company filings and communication. Directors must inform their companies of their DIN within 1 month of receipt, and companies must then inform the registrar within 15 days. Directors are prohibited from holding more than one DIN. Failure to comply with these requirements can result in penalties for both the director and the company. This system ensures transparency and accountability in director. Prevent self-perpetuating boards. The law requires that at least 2/3 of the directors in a public company be subject to retirement by rotation. At every annual general meeting, 1/3 of these directors must retire, and the company can choose to reappoint them or appoint someone else. This system gives shareholders the power to refresh the board and ensures that directors remain accountable to the owners of the company. Number of directors liable to retire by rotation is calculated by excluding independent and nominee directors from the total board strength. At least 2/3 of the remaining directors must be rotational. At each AGM, 1/3 of these rotational directors retire. If the number isn't a multiple of 3, the closest number is used. The directors who have been in office the longest retire first, and if appointed on the same day, retirement is decided by mutual agreement or bylaw. For retiring director's vacancy is not filled at the AGM and the meeting doesn't resolve not to fill it, the meeting is adjourned to the same day next week. If the vacancy is still not filled at the adjourned meeting and no resolution is passed against reappointment, the retiring director is deemed to be reappointed. However, there are exceptions, such as if the director is disqualified or if a resolution for reappointment was lost. Anyone who is not a retiring director can stand for directorship by giving written notice at least 14 days before the general meeting, along with a deposit. This allows new candidates to be considered for the board, ensuring fresh perspective. The deposit is refunded if the candidate is appointed or receives at least 25% of the votes. There are exceptions to the deposit requirement for candidates recommended by the Nomination and Remuneration Committee or the board. Listed companies may have a director elected by small shareholders, those holding shares of nominal value not more than 20,000 rupee. If at least 1,000 small shareholder, 1/10th of their total number requested, a small shareholder's director can be elected. This director is considered independent and serves for up to 3 years, but cannot be reappointed immediately. This provision ensures that minority shareholders have a voice on the board. Board may appoint an additional director if authorized by the company's articles. An additional director holds office until the next AGM or the last date the AGM should have been held. However, someone who failed to get appointed in a general meeting cannot be made an additional director. This provision allows the board to quickly fill gaps or bring in expertise as needed, but always with shareholder oversight. Alternate director can be appointed by the board if a regular director is absent from India for at least 3 months. The alternate director's term ends when the original director returns or when the original director's term expires. An alternate director cannot be appointed for more than one director at a time in the same company and must meet the same qualification, especially if replacing an independent director. Nominee director is appointed to represent the interests of an institution, such as a bank or government, that has a stake in the company. The board appoints nominee directors as per the company's articles or agreements. Nominee directors ensure that the interests of the nominating body are protected, especially when the company has received financial assistance or investment from that body. Casual vacancy arises when a director appointed in a general meeting vacates office before their term ends due to reasons like resignation, death, or disqualification. The board can fill this vacancy, but the appointment must be approved at the next general meeting. The new director serves only for the remainder of the original director's term. This ensures continuity in the board's functioning. Section 162 of the Companies Act requires that each director be appointed by a separate resolution. This prevents shareholders from being forced to accept or reject a group of directors as a block. However, if a proposal for a single resolution is agreed to at the meeting without any votes against it, multiple directors can be appointed together. This rule ensures shareholders have a real choice in board appointment. Protect minority shareholders. Companies can adopt the principle of proportional representation for appointing directors. This allows minority groups to elect directors in proportion to their shareholding, using methods like single transferable vote or cumulative voting. The company's articles must specify this system, and at least 2/3 of the board can be appointed this way. It's a powerful tool for ensuring fair representation. Not everyone is eligible to be a director. Disqualifications include being of unsound mind, an undischarged insolvent, convicted of certain offences, or failing to pay calls on shares. Directors of companies that have defaulted on filings or repayments may also be disqualified for 5 years. Private companies can specify additional disqualification in their article. These rules ensure only fit and proper persons manage company. Person cannot be a director in more than B's company at the same time, and not more than does public company. Directorships in dormant company and Section R company are excluded from this count. If someone exceeds the limit, they must resign from the excess company and inform the registrar. Penalties apply for violation. This rule prevents overextension and ensures directors can fulfill their duties effectively. Listed companies must have at least one-third independent directors, while certain public companies must have at least two. Independent directors must not be promoters, related to promoters, or have significant financial dealings with the company. They must possess relevant expertise and experience, and their relatives must also meet strict criteria. These requirements ensure that independent directors truly provide unbiased oversight. Independent directors must declare their independence at the first board meeting they attend annually and whenever circumstances change. They must also follow a code of conduct specified in Schedule IV of the Companies Act, which covers professional conduct, duties, and evaluation. This code helps maintain high standards of integrity and accountability among independent directors. Independent directors are not entitled to stock options but may receive sitting fees, reimbursement of expenses, and profit-related commission. They can serve for up to 5 years per term and may be reappointed for one more term by special resolution. After 2 consecutive terms, a 3-year cooling-off period is required before reappointment. This structure balances independence with continuity. Independent and non-executive directors are liable only for acts committed with their knowledge, consent, or where they failed to act diligently. They are not subject to retirement by rotation. This limited liability encourages qualified professionals to serve as independent directors without fear of undue legal exposure, while still holding them accountable for their actions. Independent directors may be selected from a date bank maintained by a notified institute, such as the Indian Institute of Corporate Affairs. Eligible individuals must apply online to be included, renew their inclusion as needed, and pass an online proficiency test unless exempted by experience or qualification. Companies must exercise due diligence when selecting independent directors from this data bank. Directors have a range of statutory duty, including acting in accordance with the company's article, promoting the company's objectives, exercising care and diligence, and avoiding conflicts of interest. They must not make undue gains for themselves or others and cannot assign their office to someone else. Violations of these duties can result in fine and other penalty, emphasizing the importance of ethical conduct. Beyond statutory duty, directors must file required documents with authorities, convene general and board meeting, attend board meeting, disclose any interest in company transaction, approve financial statement, and appoint auditors. Regular attendance and active participation are expected, and failure to fulfill these duties can lead to vacating office or other consequences. Director's office becomes vacant if they incur disqualification, miss all board meetings for 12 months, fail to disclose interest, are convicted of certain offences, or are removed as per the Act. Private companies may specify additional grounds for vacation in their article. If all directors vacate office, the promoter or the central government appoints replacement until new directors are elected. Directors can resign by giving written notice to the company. The resignation is effective from the date the notice is received or the date specified in the notice, whichever is later. The company must inform the registrar within T days, and the resigning director must also file a copy with the registrar. Even after resignation, directors remain liable for offences committed during their tenure. Shareholders can remove a director before their term ends by passing an ordinary resolution, except for directors appointed by the tribunal or by proportional representation. A special notice is required, and the director must be given a chance to be heard. If removed, the vacancy can be filled at the same meeting or later as a casual vacancy. Removed directors may still claim compensation for loss of office if entitled. Tribunal can remove directors in cases of oppression or mismanagement, following an application under Section 241. Directors removed by the tribunal cannot claim compensation and are barred from being reappointed for 5 years without the tribunal's permission. This process ensures that directors who harm the company or its stakeholders can be effectively removed from power. Every company must maintain a register of its directors and key managerial personnel, including details of their shareholding. This register must be kept at the registered office and be available for inspection by members during business hours and at annual general meeting. The register includes personal details, appointment dates, and information about securities held in the company and its affiliates. Members have the right to inspect the register of directors and key managerial personnel, take extracts, and request copies free of cost. If inspection is refused or copies are not provided within T days, the registrar can order immediate compliance. This transparency helps shareholders stay informed about who is managing their company. For company audit officers contravene any provisions of Chapter XI, Section 149 to 171, and no specific penalty is provided, they are liable to a penalty of 50,000 rupees, with further penalties for continuing failure. This ensures that companies and directors take their legal obligations seriously and maintain proper governance standards. In a recent case, a company delayed appointing a woman director and was penalized. However, since the delay did not harm creditors or the public, the court allowed compounding of the offense upon payment of fines by all directors. This highlights the importance of timely compliance with statutory requirements and the consequences of lapses, even if unintentional. Suppose a director is traveling abroad for 4 months. The company's articles allow alternate directors, but only the board, not the traveling director, can appoint an alternate. The alternate director must meet all eligibility criteria and cannot hold multiple alternate directorships in the same company. This ensures proper checks and balances in board composition. Sum up, the appointment and qualifications of directors are governed by detailed rules to ensure good governance, transparency, and accountability. Directors must meet eligibility criteria, act in the company's best interest, and comply with statutory duty. The law provides mechanisms for appointment, rotation, removal, and oversight, protecting both the company and its stakeholders. Understanding these rules is essential for anyone involved in company management or governance. Thank you for watching this comprehensive overview of the appointment and qualifications of directors. By understanding these provisions, companies can ensure effective leadership and compliance with the law. Whether you're a student, professional, or company stakeholder, knowing these rules helps you contribute to better corporate governance and ethical business practices.